In 2021, Elon Musk paid $11 billion in taxes. That's the biggest personal tax bill in American history. But in most other years, he paid almost nothing. ProPublica leaked his tax records a few years back and showed he paid $0 in federal income tax in 2018. Zero. Most people hear that and assume it's offshore account, shady loopholes, stuff the rest of us can't touch. It's not. It's 4 specific moves, all legal, all written into the tax code, and all scalable down to a successful operating business. By the end of this video, you'll know exactly what those 4 moves are, how to apply each one to your own situation. I'm Anthony. I run a CPA firm that works almost exclusively with entrepreneurs. My clients run businesses doing $1 million, $5 million, $50 million in revenue, multiple entities, real estate, complex structures. Here's the frustration I hear constantly. I'm making good money, but when tax season hits, my CPA just tells me what I owe. No strategy, no plan. Then I read an article about Elon Musk paying 0 in taxes and I think, what the hell am I doing? The answer is, you're probably not doing anything wrong, you're just playing a different game. The people paying the least in taxes aren't hiding income. They've structured their financial lives so income is recognized on their terms, not the IRS's. One thing I want to be upfront about before we go further, these moves don't scale to every business in the same exact way. Each one has a rough threshold where the math starts working. I'll flag those as we go. But if you're running a profitable operating business with appreciating assets on the side, all of these apply to you. Let's get into it. Elon Musk takes $0 in salary from Tesla. 0. His compensation is structured as performance-based stock options tied to Tesla hitting specific market cap and operational milestone. Here's the part people get wrong. They think equity compensation is magically tax-free. It isn't. Let me break it down because it matters. When Elon exercised a massive block of his options in 2021, the spread between the strike price and the market value became ordinary income. That's the $11 billion federal tax bill. His equity wasn't tax-free, it was tax-deferred. He picked the year to pull the trigger. Now there's 5 main flavors of equity compensation, and each one gets taxed differently. Non-qualified stock options trigger ordinary income on the spread between the strike price and the market price at exercise. That's the bucket Elon's 2021 exercise fell into. Incentive stock options defer regular income tax until you sell, with alternative minimum tax possibly hitting at exercise, and you qualify for long-term capital gains rates if you hold long enough. Now, restricted stock units hit as ordinary income at vesting, but restricted stock with an 83B election lets you lock in a low basis at grant, so future appreciation comes out as capital gains. Now, there's a 5th one, and it deserves its own deep dive because it can eliminate federal capital gains tax entirely on millions of dollars. Section 1202 Qualified Small Business Stock, QSBS. This is one of the most powerful provisions in the entire tax code, and almost nobody talks about it. And it just got a major upgrade. For stock issued on or before July 4th, 2025, the old rules apply. 5-year hold, exclude up to $10 million or 10 times your basis from federal capital gains tax completely. For stock issued after July 4th, 2025, under the One Big Beautiful Bill Act, it's even better. Tiered structure now. Hold 3 years, you exclude 50% of the gain. 4 years, 75%. 5 years, full 100%. And the per taxpayer, per company exclusion cap went from 10 million to 15 million. But that's where it really gets interesting. The exclusion cap is per taxpayer, not per company, not per transaction, per taxpayer. Which means if you give QSBS shares to family members before a sale, each family member gets their own cap. I had a client whose company qualified for QSBS. Before the sale, he gifted shares to his kids, to his parents. When the sale closed, all of them sold multi-million dollars of stock each. Every single one of them paid 0 federal capital gains tax on their share. Across the whole family, over 25 million in total capital gains recognized, 0 federal tax. That's millions of dollars, shifted from the IRS to his family completely legally because we stacked the per taxpayer exclusions. That's what Elon level tax savings actually looks like in practice for a real business owner. Notice what's happening. Equity compensation doesn't eliminate tax, it gives you control over 4 things. Timing, you pick the year the income hits. Character, you steer the income from ordinary rates up to 37% federal down to capital gains rates max 23.8% with a net investment income tax. That alone cuts a big bill by 1/3. Location, if you're a resident of Texas or Florida, when the event triggers, no state tax. We'll come back to that. And optionality, as long as you don't exercise, don't sell, don't vest past, the underlying value continues to compound untaxed. So how does this scale to a closely held business owner? Most entrepreneurs actually can't pay themselves in stock options, but the principle still applies. Don't overconvert business profits to higher taxed income unnecessarily. The most common overconversion I see is S-Corp salary, but the YouTube version of this strategy gets it wrong half the time. The right S-Corp salary isn't always lower. Sometimes it needs to come down to save self-employment taxes, but sometimes it needs to come up to capture a higher QBI deduction, which on its own can swing your income tax bill by tens or even hundreds of thousands of dollars. Now, the right salary number depends on your business type, total income, what else is flowing through the entity. Real ranges from my actual client work, a business owner profiting somewhere between $100,000 to $400,000 a year with a reasonable comp strategy across salary, distributions, retirement, and reimbursements will often save 5 figures in taxes annually, sometimes more. For someone in the high 6 to 7 figures of income, that same coordinated approach regularly clears 6 figures of annual savings, not from any one tactic, but from the integration of all of them. Bottom line on move one, the principle isn't take stock, avoid tax, it's control the trigger. That applies whether you're Elon or whether you're running a $2 million business out of your home office. Now, this is the one almost everyone's heard rumors about and almost nobody understands correctly. Buy, borrow, die. Step 1, buy or make assets that appreciate. Stock, real estate, equity in private companies. Step 2, when you need cash, don't sell. Borrow against the asset. Step 3, pass the assets to your heirs at death, where most of the time they get what's called a step up in basis. Here's why this works. Loans are not income. When you borrow $1 billion against your Tesla shares, the IRS doesn't care. It's debt, not a paycheck. Cash in pocket, zero tax. Reports in 2022 showed Elon had pledged around 88 million Tesla shares as collateral for personal loans. He's not selling stock to fund his lifestyle, he's borrowing against it. Now, here's where step 3 plays out differently for normal humans versus Elon. Now, when you die with appreciating assets in your estate, your heirs get what's called a step up in basis. That's IRC section 1014. The basis on those assets resets to fair market value on the date of death. So if you bought a rental property for $300K and it's worth $900K when you die, your heirs inherit it at $900K basis. Sell the next day, zero capital gains taxes. The $600K of appreciation, tax-free. That's one of the most valuable provisions in the entire tax code for anyone passing wealth down to their family. Now, here's why it doesn't work cleanly for Elon. The federal estate tax exemption in 2026 is $15 million per person, $30 million for a married couple. Anything above that gets hit with the 40% estate tax at death. Elon's net worth is in the hundreds of billions, almost $1 trillion. He's got an estate that would lose 40% at death unless he actively plans around it. So at his level, the strategy gets layered. Move appreciating assets into irrevocable trusts now while values are low, so future growth happens outside the estate. Grantor retained annuity trusts, GRATs, to freeze the estate value. Dynasty trusts in states without a rule against perpetuities. Generation skipping transfer tax exemptions used strategically. How about private foundations? Elon has one, the Musk Foundation. At his scale, those really aren't optional. Like, they're how you compress a taxable estate that would otherwise get demolished upon his passing. Now, here's the upside for you. If your net worth sits between $0 and $30 million as a couple, you're in a structurally better position than Elon on this move. You're under the federal estate exemption. You get the full step-up benefit without needing to build a trust and foundation labyrinth to access it. You can buy, borrow, hold, and die. The goal, if you're serious about passing wealth to your family, is to pass away with as many unrealized capital gains as possible under the estate tax exclusion limit. Little morbid, but you can seriously save a lot of taxes this way, because every dollar of appreciation that goes untaxed at your death is a dollar your family gets to keep. Let me show you what this looks like in a real situation. 2 examples. Example 1, real estate developer. He buys properties, rehabs them, significantly increases the fair market value through the work he puts in. When he wants to cash out the new equity to fund the next deal, he doesn't sell. He goes to the bank and either refinances or pulls a HELOC based on the updated value. That extracted equity rolls straight into the next property. He's been doing this deal after deal, compounding his portfolio without triggering a single taxable sale. Every one of those properties is sitting there with decades of appreciation, waiting for the step up when he dies. His kids inherit a real estate empire with fresh basis. Example 2, client near retirement. Low income at this point in his life, he'd accumulated close to $1 million in Bitcoin over the years and wanted to buy a house, highly appreciated Bitcoin. A normal CPA would have said, sell the Bitcoin, pay the capital gains, buy the house. We looked at his total taxable income for the year and saw he had a lot of room inside the 0% long-term capital gains bracket. For 2026, single filers pay 0% on long-term gains up to $49,450 in taxable income. Married filing jointly up to $98,900. He had about $75K of gains he could recognize at 0% federal capital gains tax, federally tax-free liquidation. Now for the rest, roughly $300K to $400K, he took a crypto-backed loan, borrowed against a Bitcoin, and used the cash to round out the house purchase. He bought the house, kept the Bitcoin position intact, and paid 0 federal tax on the entire transaction. 0. The $75K of gains sat inside the 0% bracket. The $300 to $400K he borrowed wasn't taxable income because loans aren't income. The interest he paid on the loan was significantly less than the capital gains tax he would have triggered on a sale. Same principle both times. Don't force a taxable event, borrow and hold. You don't need Elon level wealth for any of this. You need a few $100,000 in appreciated assets and a banker who knows what they're doing. But it has to be structured right, which is where most entrepreneurs fall apart. And quick pause. If you already made it this far, you're already ahead of most of my intake calls. The gap between understanding this stuff and actually implementing it is where most entrepreneurs lose 50, 100, sometimes 200K a year. So if you want to look at your own situation and figure out which of these moves fit your business, links in the description, book a strategy call with me or my team. We'll run the numbers on your actual return, not just generic advice. Okay, back to move 3. In December 2020, Elon Musk moved from California to Texas. A year later, Tesla followed and moved its headquarters from Palo Alto to Austin. California's top state income tax rate is 13.3%. Texas has no state income tax, 0. When he exercised that massive block of Tesla options in 2021, triggering the $11 billion federal tax bill, he paid $0 in state income taxes on it. If he'd still been a California resident, that single transaction would have cost multiple billions more in state tax alone. That is domicile arbitrage. The tax code doesn't just care what you earn, it cares where you are when you earn it. Now, I'm not saying every entrepreneur should move to Texas. That's a huge life decision. But think about this from a lifestyle angle, because most of my clients have way more flexibility than they realize. How many people do you know who live in New York and fly down to Florida for a few months every winter? Quite a few, right? Why don't we flip it? What if you lived in Florida and flew up to New York for a few months every year instead? Someone making $1 million in income living in New York City is paying roughly 13 to 14% combined state and city income tax. Call it 130 to 140K a year every year, going to a tax jurisdiction most people never think to question because it's where they've always lived. Make Florida your domicile. Real residence, real estate, driver's license, doctor, voter registration, like the works. You can still spend 5 months a year in New York, hit the good months. Spring, summer, early fall, avoid Florida's worst heat, avoid the hurricanes. Similar lifestyle you probably already want, and you save 140K a year. And that compounds. 10 years of it, $1.4 million before the growth of what you invested in it. Now, one warning, establishing domicile isn't a verbal declaration. It's how many days are you present? Where's your driver's license? Where's your voter registration? Where do you get health care? What clubs are you a part of and where are those? Where's your primary home? Where do your kids go to school? States like New York and California audit former residents aggressively. So if you move for real. But beyond your personal residence, there's also where your entities sit. Wyoming, Delaware, Nevada, these states have favorable charging order protections, privacy, and sometimes state-level tax savings. But a Wyoming LLC does not save you federal tax. It only protects your assets and your privacy. And where your real estate sits affects your tax exposure, not just your cap rate. Like one client of mine sold a business last year for $8 million. He'd been a Florida resident for 18 months at the time of the sale. If he'd still been in New Jersey, where he'd been his whole adult life, he'd have been paying into the New Jersey millionaire bracket. Top rate there is 10.75% on income over $1 million. State tax on that sale would have come in around $830K. 0 in Florida. So the 18 months he spent establishing real domicile saved him more than $800K on a single transaction. So the state your entities are registered in, one decision. The type of entity is a separate decision, and for most entrepreneurs, it matters more than where they're filed. Start with how this works at Elon's scale. Elon doesn't personally pay tax on Tesla's profits. Tesla does. Tesla is a C corporation, and the corporation pays its own tax bill on what it earns. But here's what's interesting about how Tesla manages that bill. They reinvest aggressively. Property, equipment, factories, R&D. Tax law lets you depreciate, expense, take credits on a massive chunk of that reinvestment. And when depreciation expense exceed taxable income, the company can be cash flow positive, growing the business, and still show a near 0 on the tax return. Tesla has had plenty of years like that. So have plenty of capital-heavy companies. That isn't a loophole. It's literally how the corporate tax code is built. Reinvestment gets rewarded, and you can play the exact same game at your scale. The starting point is the right entity choice for your situation. So, 3 rules of thumb. If you run an operating business and you pull most of the profits out as income, an S-Corp is usually the right structure. S-Corp lets profits flow to you while saving self-employment tax on the distribution portion. Most of my profitable service business clients are S-Corps for this exact reason. Now, if you're a founder building a company that's going to keep reinvesting, raise outside capital, grow the value of the equity itself, C-Corp is usually the right structure. C-Corps are how you access the QSBS strategy from earlier, take a modest salary, let value compound inside the company, exit with up to $15 million per shareholder excluded from federal capital gains tax under 1202. That's the Elon style move scaled down. Now, if you're investing in real estate, especially partnering with others, an LLC is usually the right structure, either a sole proprietorship or a partnership. This entity type unlocks the most flexibility with your depreciation, meaning rental cash flow on one side, depreciation deductions large enough that taxable rental income comes out to 0 or even a large paper loss that offsets your other income. That's why real estate is one of the most tax-advantaged asset classes in the code. The wrong entity for your situation can cost you tens of thousands every year, sometimes hundreds. And most entrepreneurs I meet have an entity their first accountant put in place when the business was small and nobody's revisited it since the situation changed. Here's where entrepreneurs go wrong trying to replicate this stuff. Mistake 1, they misuse the borrow leg of buy, borrow, die. There's 2 ways to wreck this strategy. First, borrowing against the wrong asset. They pull a $300K HELOC and dump it into crypto or some speculative deal, and when the asset craters 40%, they're paying interest on a loan against a shrunken asset. Buy, borrow, die works on assets with a long track record of appreciation. Stock, established real estate, mature businesses, not gambles. Second, borrowing against the right asset but spending the money on lifestyle. Borrowing against your rental portfolio to buy the next rental, that's the play. Borrowing against your stock to upgrade the car or fund a vacation, you've turned a wealth building tool into expensive consumer financing. The asset you bought loses value. The debt does not. Now the rule is simple. Every dollar you borrow should fund an appreciating or income producing asset. If it can't pay for its own interest and then some, don't take the loan. Mistake 2, the LLC is in the wrong state for their actual life. I had a client who moved from California to Texas, set up a Texas LLC, started operating his business out of it. Great. A year later, he moved back to California. He kept the Texas LLC, he kept running the business. But then he called me furious that he owed California income tax and S-Corp franchise tax on the business while he lived there. He assumed the Texas LLC protected him. It doesn't. California doesn't care where your LLC is registered. If you, the owner-operator, are a California resident actively running the business from California, California taxes the income. The state of residence follows you. The structure has to match the reality. Mistake 3, they trigger equity compensation without a plan for the tax bill. This is the flip side of section 1. Stock options, RSUs, not tax-free, they're tax-deferred. And when the deferral ends, you owe tax in cash that year. I've seen entrepreneurs exercise a big block of NSOs, assume they'd sell enough shares to cover the tax bill, but before they do so, they watch their company's stock drop 40% before they file. Now they owe a huge tax bill on income they didn't actually make while holding an asset worth a lot less than they thought. Or they exercise ISOs and don't realize AMT is going to hit them until March. So if you're triggering equity comp, model the tax bill before you pull the trigger and make sure liquidity is in place to cover it. You should probably have a professional helping you. Mistake 4, they wait until tax season to think about any of this. By April, every opportunity for that tax year is gone. Every strategy I've described has to be set up in advance. The clients who save the most are doing tax planning in June, not scrambling next March. So here's what I'd tell you if you were sitting across from me right now. First, pull your last tax return, look at line 1 wages, then look at what's flowing through on your K1 or Schedule E. The right ratio of those numbers depends on your business type, your QBI position, your total income. So don't just assume less W-2, the better. Run the full math or have someone run it for you. Next, make a list of every appreciating asset you own: personal real estate, rental properties, investment accounts, business equity. For each one, ask 3 questions. What's the basis? What's the current fair market value? And do I have a borrowing facility set up against it? If the answer to the last one is no, you want it to be yes, your next conversation is with your banker. Third, if you have meaningful appreciated assets, get an estate plan done. The step-up in basis is the most valuable gift the tax code gives to the middle wealth entrepreneur. Don't die without an estate plan that makes it really hard for your family to claim it. Fourth, run the domicile question honestly. Where do you actually spend your time? Like, where are your kids in school? Where are you on December 31st? If there's a gap between where you live for tax purposes and where you live for your life, maybe close it. Fifth, check your entity setup. Are you in the right type of entity for what your business actually does? S-Corp for operating profits you pull out, C-Corp for founder building companies that reinvest and exit, partnerships for LLCs and partnerships for real estate with co-investors. If your entity was set up when the business was small and nobody's revisited it, that's a 6-figure decision waiting to be made. And 6, if you're expecting any kind of liquidity event in the next 18 months, business sale, property sale, equity vesting, inheritance, stop reading articles, get professional help. The window to structure around a big event is measured in months, not weeks. Here's a takeaway. Elon doesn't avoid taxes because he's a billionaire. He avoids taxes because he controls the trigger. He decides when income happens, where it happens, and what character it takes. The unrealized gains he's not pulling the trigger on are compounding in a way that IRS can't touch until the trigger gets pulled. And every one of these moves has a version that works at your scale. You don't need Tesla. You need a profitable business, some appreciating assets, and the discipline to plan before you execute instead of the other way around. So if you want help putting this together for your own situation, links in the description. My team runs through exactly this framework on every strategy call. And hit subscribe if this was useful. I break down a different tax strategy every week. See you in the next one.